Uranium seems like a solid investment, so it would be interesting to take a look at a uranium miner ETF, and that's exactly what we're doing today. Hey, my name is Tucker Krause and welcome to my channel. Today's video I'm going to be taking a look at URA, a uranium miner ETF. I'm doing this because just a couple days ago a viewer commented and asked about it, and I took a quick glance at it and thought it would be interesting to make a full in-depth video on. Though today's video will be shorter than usual because of course an ETF is a good bit simpler than going over an entire company or comparing a whole bunch of different companies, but nonetheless it's because I'm running short on time and so this seems like a good video too. Either way, they also have recently rebalanced the ETF just in the last couple days, so I thought it'd be interesting to take a look at those updates as well, and so because of that, it of course makes this a very timely video. Literally, it got updated between that comment that inspired me to make the video and making the video, so very recent.
So, just have this informational website pulled up here. Why URA? URA is a targeted play on uranium mining and the production of nuclear components. In a single trade, URA delivers efficient access to a basket of companies involved in uranium mining and producing nuclear components. So that means we aren't going to be just looking at uranium miners in this portfolio, right? You can see right here because there's multiple different sectors in here. Though the more notable thing is when you look at the geographic breakdown, it is very diverse. We have a whole ton of different countries in here, though it is of course very biased towards Canada, but that's because lots of the companies with the highest grade deposits are in the Athabasca Basin, which is of course in Canada. Though it's better than, say, every single company being in just China, for example. So when we go to top holdings, we can see it was just updated, and we can see Cameco makes up over 1/5 of net assets, which definitely shows they're going for a low-risk portfolio here, since, of course, a multi-billion-dollar producer is going to be a lot less volatile than, say, a 200 million market cap explorer. And we can see there are also a lot of other popular developers and explorers here, right? We got NextGen here, we got Denison here, etc., etc. They also have some things like Yellowcake for, of course, the uranium just price movement in general, not necessarily around a deposit or a mine, and that's at about 3% here. Now, as you can see, there's a lot of non-uranium mining companies or non-mining companies in general, right? We have CGN Power here alongside, when you go down here, CGN Mining. There's also things like Samsung and Mitsubishi, which, you know, aren't exactly out there mining uranium, but they're likely, that would make sense to me, that some of these companies would be producing nuclear components, since they are very large manufacturing companies. So when you hop over to this tweet here, you could see that it's about 72% purely uranium mining stocks, which to be fair means that this portfolio once again is lower risk but far lower reward, because it's not quite, because all these companies that aren't, you know, mining uranium aren't as leveraged to the uranium price movements as, say, just a company that is producing some nuclear components. Though some things I would note here is that companies like, at least this is the main notable example, Rio Tinto doesn't even have really anything to do with uranium anymore because they sold off their one uranium mine quite recently. Though the other thing I want to note here is Kazatomprom is only at 8.3% right now, but before it used to be at 22.5%. So this is a significant drop down, because before Kazatomprom and Cameco alone made up about half of this entire ETF. So I actually like that regardless of the reasoning, but you can see that right here, that it is a bit more diverse here, not quite all lumped into just two companies. So just hopping over to Yahoo Finance, we can see they're actually trading a little bit below their net asset value right now, which essentially means that this ETF is technically undervalued right now. Though, of course, that depends. If these companies were horrifically overvalued, cough, cough, and they were trading below net asset value, this might not actually be an undervalued ETF. But, of course, do your own research there. In general, this ETF is undervalued, but the companies may or may not be. Now, their expense ratio here is 0.69%, which is actually quite low for an actively managed fund, since, you know, by the time you start getting into 1.5%, that gets quite high. Though if you look at, say, like passive Dow Jones or S&P 500 ETFs, it can be lower than that. But for an actively managed fund, this is really good. Thing to note that's interesting is that they have a 0.6% yield, despite the fact that Cameco, their largest holding, is 0.35% yield, and many of their holdings have no yield. But that's likely due to some companies like Rio Tinto and BHP having obscene yields over 5%. The other thing I want to note here, just the last thing I want to note, is that their net assets seem to be significantly smaller than lots of other ETFs. We can see right here 25 billion, though I imagine that will fall quite soon, or at least not soon, but you know, eventually. And then the S&P 500 over here, this S&P 500 ETF, 375 billion. So that kind of does show, hey, maybe we're a little bit earlier in this uranium play compared to overvalued growth stocks or something. So now let's roll to the outro.
Overall, it seems like the URA ETF is a solid way to get into uranium while limiting your risk if you're someone who is newer to investing and maybe isn't as sure how to look over all these different companies. Though, of course, because it's lower risk, that of course means there's lower rewards, since if, say, one company skyrockets, it's not going to go up as much because it's only a small part of the ETF. Not to mention, in general, because Cameco makes up so much of the ETF, Cameco isn't going to move as far as a much smaller company because its market cap is so much larger and so much harder to move up. Either way, seems like a great investment for someone who is just getting into the uranium space. So without further ado, thanks for watching, smash that like button, and I will see you next time.